Hey everybody, I hope you're doing well out there. This is your April market review. For those of you this is the first time you're watching one of these videos, the reason that I put these videos together each month is to give you the straightforward information with no media spin, political angle, or fear tactics that many media outlets use to get more viewers to watch their shows. My goal with this ultimately is to give you the information about what's going on in the stock market and the economy, and then ultimately how that ends up affecting your money as an investor. So stocks were down across the board in April. The S&P 500 was down close to 9% for the month, while the NASDAQ was down close to 13%, marking actually the worst month for the NASDAQ since 2008. It's one of the worst months for the S&P 500 in a long time as well. The S&P 500 sits down about 14% year to date as of right now, which is right at its lows for the year. So the drop after that was a drop after really a rebound in March, where the market was up 5.5–6% in March. At least looking at the S&P 500, was up about 5.5%. The bad news that led to stocks dropping was more concerns about a recession because of increases in interest rates to help slow down the pace of inflation. So we're at a turning point right now within stocks where stocks have dropped in anticipation of bad economic news, despite companies reporting relatively good earnings on average. So I'm going to talk more specifically about obviously the stock market drop using some different charts. If you haven't watched these before, I love using charts because I feel like that's the best way that I can articulate different points and also then speak around those. So the first chart that I have here is the federal funds target rate, which when I say that they're increasing interest rates to help slow down the pace of inflation, that's what I'm talking about. Because the way that the Federal Reserve, which is the part of the government that controls interest rates and monetary policy, the way that they try to help control inflation and keep the economy running on good footing is by interest rates a lot of times, or they can do quantitative easing and a number of other things, but interest rates is the primary tool that they use to either get the economy going or to slow the economy down, which is what they're trying to do right now. Because despite what many media outlets may have you think, the economy is doing actually too well. The economy is white hot, which is one of the reasons why that inflation is so high. So this chart here shows that the interest rates in 2020 went from about 2% all the way down to basically zero, which is where they sat here up until March, when they raised interest rates 0.25% for the first time since the COVID crisis started. So, and I'll get back to that point of why the market is doing so white hot. So one of those reasons is because if you're looking at it like, well, stocks are dropping, the economy must be doing terrible. So that is a big part of what will play into the economy, because that's referred to as the wealth effect, which my last chart goes into that, talking about home prices. But the wealth effect is how we all feel about our financial state based on how much we're worth. So a perfect example would be is you open up your statement at the end of the month and you see it's either up or down. And if it's up, you feel a little bit better about yourself financially. If it's down, not so much. So, you'll see that here if you open up your statement for April, or go online or pull up the app for the portal. You'll see where your accounts are at. You can see the 1 month difference. You can see the year-to-date difference. If you then go backwards over time, obviously over time, everybody's made money as long as they've been with me for at least over a year at this point. But and whether you've been with me or not, you're going to see over time that if you were invested in stocks for more than a year, you're likely higher. So, but that's called the wealth effect, which is a big part that ends up dragging down on investor sentiment. So people just don't feel as good about the economy because they see that stocks are down. So on the positive side of it, though, is that employment or unemployment is at a 50-year low. So we got back to the same spot that we were at before COVID had started, where unemployment rates were at about a 50-year low at that point. Jobless claims are also at a very low point moving forward, and The reason being for that is for every unemployed person, there's 1.8 jobs available for them, meaning there's roughly about 2 jobs for every 1 person that's unemployed, meaning that not only is there a job available, there's actually 2, and they get to choose which one that they'd really want. So, which is one of the reasons why small businesses have a record level of job openings. So over 50% of small businesses have job openings that they can't fill. So that's a good sign for the labor market and people that are looking for jobs and people that are looking to get paid more, because what these companies are going to have to do is they're going to have to start jacking up the wages that they're paying their employees to stay competitive. So what we've seen is that wages haven't kept up with inflation, which is a small issue that people are feeling right now, relatively speaking. So, and I have another chart here that'll go into consumer spending, and that's why I say it's a small issue, because people are still spending money. That's my next chart. But before I get to that, so this chart shows the federal funds target rate going all the way back into the 80s, and fast forwarding here through today. So the Federal Reserve has announced that they're going to do a 0.5 percentage point move in May, which is the first time that they've done that large of an increase in 22 years. One of the reasons why stocks had dropped off the second half of the month the way that they did, and the reason for that is that investors in stocks are concerned that if they raise interest rates too much or too quickly, that it could put us into a recession and slow down the economy too much. Those are some different things that investors are concerned about as far as interest rates going up too quickly. The last time that we had this type of interest rate increase was way back in 2016, where interest rates started creeping up at that point. And then, because of COVID, they ended up having to drop them, which then that helped stimulate the economy when they lower rates. Okay, the next chart that I have is showing the US consumer spending change from February 2020 through the present. So the reason this chart exists is because February 2020 was the last normal month prior to COVID. So I thought that this chart was interesting, and the reason I wanted to bring it up is because this shows the strength of the economy right now. So in the nominal level, that just shows how much it's gone up with overall spending, but the inflation adjusted obviously shows that it's a lot lower than that. Still positive, up 5%. So you see the big drop off that we had during COVID because people stopped spending money during COVID and everybody just bunkered down at the house watching Netflix, hanging out, eating popcorn, watching Lion King. But things changed after a few months where all of a sudden people started spending more money, and especially with the stimulus that they got, they decided to spend more of it because either if they weren't affected from a job standpoint by COVID, they had more money at that point. And we see that here today where even with inflation, people are still spending a lot of money out there. And that's one of the healthiest signs of our economy, is to see what consumer spending is doing or what consumers are spending. Because if they're gonna stop spending money, a large part of our economy, about 2/3 of our economy, is based on consumer spending. So if that goes negative, likely, that's going to lead to a recession or at least a slowdown within the economy overall. So I thought that was an interesting chart to just kind of show, what that level looks like for what it looks like from a positive standpoint on the economy, because obviously if you're looking at the stock market right now, not as pretty of a picture at the moment. So a lot of the reason that we're in the spot that we are from an economic or from a stock market standpoint is because of where the economy is at and it being too hot at this point. So, and that's one of the reasons that they're raising interest rates like I had talked about before. And that is to combat inflation, which brings me to my next chart here, which shows the personal consumption expenditure price index, the change from 1 year earlier. So this is the number that the Federal Reserve looks at as their target for inflation. They'd ideally like it to run a little bit above 2% over time. You can see that it's well above that 2% level, and it's more like that 6-7% level where it's currently sitting at. This shows all the way back through the 60s, just so that way you can get kind of a gauge of where things are at versus prior years. For the last decade, we ran right around 2%, if not below that. the struggle that the Federal Reserve had was that there wasn't enough inflation. So, and that's one of the reasons why they continued stimulating the economy with keeping interest rates near zero and buying bonds and mortgage-backed securities to help stimulate the economy and the housing market. So you can thank them for that, for your housing prices going up, which is my last chart today. So not all bad things, but it was for the reason of making sure that they didn't take their foot off the gas too soon and our economy didn't recover as quickly. So which they did the opposite, where they kept it on probably too long, or it was too long, and now we have higher inflation because of it, which they're trying to rein in by increasing interest rates. It's not a good thing for stocks in the short term, but it's a good thing from a long-term standpoint. If we look forward 10, 15 years from now, this is going to be a minor blip on the overall chart of the S&P 500 and stocks from a broader basis. We're just in the thick of walking through the mud at this point. So that chart I thought was interesting to kind of show you one of the reasons why they're increasing interest rates, because inflation is at that higher point. Next chart I have goes into something that's being very much so affected. It's one of those things that we all feel, which is oil prices. So this shows oil prices from the beginning of 2021 through today, and then they have dotted in there the Russia invading Ukraine, which was the beginning of oil markets really taking off and spiking up to above 120, almost 130 a barrel, and back down to 100, back and forth here. So we're still above $100 a barrel on oil, which for your portfolios, one of the things that I had done in the very beginning of April was actually sold a good portion of energy stocks that are held within your portfolios. The reason being for that is to take in some of the gains that we've gotten from energy. Energy is the best sector and the best individual part of every one of your portfolios this year. And what I did with that is I actually used that to raise cash, so that way we had some money kind of sitting on the sidelines, as well as some other positions at the very beginning of April. I raised cash. We brought up, for more aggressive portfolios, we actually brought up the cash position to about 9%, 10% in a portfolio, which what I'm going to use that for is buying some positions that are really taking a beating this year. One of those might be semiconductor stocks and technology, which are very undervalued, especially technology at this point, because technology, which is a large part of the NASDAQ, is down 20% for the year, and technology is the largest segment of the NASDAQ. So that's an area that I'm likely to increase. I thought this was just an interesting chart. Kind of shows you where oil prices were, where they're at now, one of the reasons that gas prices are at the level that they're at. So, this was a natural thing that was going to end up happening, because we had shut the economy down in 2020 and oil prices had dropped. At one point they were actually negative on a shorter term basis, but and they've rebounded since then. But energy companies, think like Chevron and Exxon, those companies, their break-even point for oil, for them to be profitable, they need oil to be above $35 a barrel. So, even a year ago, they were profitable at $50 a barrel. But at $100+ a barrel, that just adds more to their bottom line. So, these are companies that are really going to be doing well from a profitability standpoint, and likely I'm going to be increasing the weighting back into those at some point when we get maybe a little bit more of a pullback within the markets, or energy more specifically. So just kind of keep note for that. Last chart that I have here goes into, because I want to end this on a very positive note, is circling back to that wealth effect that I talked about in the beginning. For those of you that are homeowners out there, this is something that this chart shows the median sale price of existing homes going all the way back through 2000, going into today. So median price at that point was about $150,000 for the median sale for a home price at that point. So in central Pennsylvania, we moved pretty closely alongside of this number. So the median is definitely a little bit, maybe a little bit lower than this, but it's pretty close actually. So and for those of you in different parts of the country, this is a US based number. So whether you're in Florida or Texas or wherever, the Carolinas, wherever you're at, your home prices are going to move roughly alongside of this from a percentage standpoint. So, the chart would just be maybe a little bit of a different number on the left-hand side. So we've seen this huge spike since the beginning of 2020 where in 2020 we were below $300,000. Everybody has seen, or at least as far as the median goes, about $100,000 increase to their house based on the median there. So that's one thing that, from an economic standpoint, the Federal Reserve buying mortgage-backed securities like they were doing helped really stimulate the housing market, and by them not taking their foot off the gas soon enough, that inflated home prices. So now you see what happened during 2007 through 2008. That was the real estate bubble bursting, and the overall economy at that point was in a deeper recession in 2007 through 2009. And it took all the way through 2012 for home prices to really flatten out and move higher. But typically, homes don't really go down in value. Like that 2008 time frame is more of a rarity where home prices really drop off significantly in value. So for those of you out there that are looking at buying a house maybe for the first time, or you think that there's going to be this big drop off within the housing market, I wouldn't necessarily go about it that way, because the likelihood is that housing prices will just not increase as much moving forward. So from March of last year through March of this year, and that's the most recent number that's come out, the increase was 15%, which was a very big increase as far as housing prices go. So it may not go up at that much, but if it still goes up at 2, 3, 4, 5% in that range, that would be maybe more of a normal number, because on average, home prices move at like 3, 4% over time. So, it's something that if you're renting right now and you're looking at buying, looking at considering what your options are from a financing standpoint may be a big thing. Now, interest rates have gone up a lot, so that's another consideration you have to take into effect. But this is a good thing for people that are current homeowners, that housing prices have gone up as much. If you're sitting on the sidelines renting right now, not as good of a thing for you because of prices continually going up and interest rates going up alongside of it. But if you're a homeowner, this is a good thing, because going back into the wealth effect, people feel good about a house in their neighborhood selling at 20% more than what their house was worth a year ago. So when we're looking at your overall financial picture, know that the equity within your house is also part of that. Not necessarily that you plan on selling your house, but that is still part of your overall net worth at the end of the day. So I'm going back to, if we've never done a financial plan and you're concerned with where stocks are at this point, and you're a little shaky on where you're at, whether you're retired or you're considering retirement, it'd be a good idea to do a financial plan. So that way, in times like what we've had here where stocks are down 14% for the year, you can see, well, how does that really affect your overall financial plan? And for most of you, I would say that it's not going to affect your financial plan at all, because 14% isn't that large of a drop in the grand scheme of things. So a 14% drop can be very easily made up over a number of months, especially with the economy, if inflation were to really top and start going down the other way, and they didn't have to continually keep raising interest rates. So that's that's the half glass full side of things that I'll give you for that. For those of you that are in Pennsylvania that I do in-person reviews with, if we haven't gotten together since December, I'll be reaching out to you over the next couple weeks here to set up investment reviews for the last couple weeks of the month. I'm very flexible the first couple weeks of the month to do Zoom meetings, to do investment reviews, or if you have questions, feel free to reach out to me. The last couple weeks of the month, I'll be in Pennsylvania doing the in-person reviews, so I'll be a little bit more tied up to do Zoom meetings at that point. So if you have any questions or need my help for anything, don't hesitate to reach out, call, text, email. If you have friends or family members, coworkers, someone that you feel would be interested in having a conversation with me about their investments, please don't hesitate to give them my info. If they'd like me to reach out to them, I'd be more than happy to reach out to them and have that conversation as well. Just give me their information. But if we didn't get together here last month, or if we did get together here last month and we're not getting together this month, I look forward to seeing you guys that I got together with you this past month in the fall again. and look forward to seeing those that I'll get together with here later this month in person or just talking to. But I appreciate you all for taking the time to check me out. Until next time.